I'm Greg Hunter. Welcome to USAWatchdog.com, where there's a return trip by the author of this book, The Money Bubble. It's only about 4 years old, and I asked him, have you revised that book? He says, well, actually, no, because I was so early with it that all the stuff that in this book is happening right now. We'll talk about that, and also one of his latest articles about his predictions, the three for sure things are going to happen in 2019. I'm talking to John Rubino of dollarcollapse.com, one of the first sites I started following when the internet started taking off years ago. John Rubino, thanks for joining us today on USAWatchdog.com.
Hey, Greg. Well, thanks for having me back on.
Well, I love your report. I want to talk about that because it's kind of a predictive thing for 2019. Because I'm looking for people, to make some predictions as to what's going to happen in 2019. And you at least started that with this article that, three things that were going to happen in 2019. What is your estimation of three things that are going to happen in 2019? Let's just start there with your latest article out about a week ago.
Well, I should say that I got a lot of really sarcastic comments about this article. People saying, wow, you really went out on a limb with this. Because I said that government deficit spending was going to accelerate in the year ahead. Corporations were going to stop buying back their stock, and that politics were going to get even crazier in both the US and Europe. I guess all of which a lot of people saw as not very aggressive predictions, because all of those things are kind of expected. But my point with it was that you combine those three things, and it makes it very hard to predict, for instance, the financial markets. But let's circle around to that later and start with the predictions themselves, I guess. First of all, the fact that deficits are growing in a lot of big countries is really extraordinary, because we're 9 years into a recovery. And historically, for instance, go back to the George W. Bush days or the Barack Obama days, and certainly the Bill Clinton administration. And towards the end of expansions, government finances get pretty solid. Everybody's at work and they're all paying taxes, and capital gains are flowing in from the stock market. And that shrinks deficits and makes everybody stop worrying about government finances. This time around, we're 9 years in, and our deficits are growing in the U.S.
Exploding.
We're running $1 trillion deficits, yeah. And that is before a lot of the spending that's in prospect now. We got a big infrastructure plan coming, and we're going to build the wall, and we're going to do lots of other things. So $1.5 trillion is not out of the question before the next recession hits. And then when the recession hits, normally deficits double from the last year of expansion to the trough of the recession. So we could be looking at $2.5, $3 trillion deficits on top of all the money that we've borrowed already. But U.S. isn't alone. The European situation is so crazy on a lot of different levels that it's forcing governments there to increase spending. France in particular, France raised taxes, had riots in the streets where people were setting fire to parts of Paris, and then they caved and said, okay, well, we'll cut taxes and we'll increase spending. Will that make you happy? And so they're going to run big deficits.
Well, yeah, Germany, and they raised taxes because of this forced immigration, that they are bringing in all these people, and none of them have jobs. So all the taxpayers who are working are paying for these millions of people. In Germany, it's the same story, and all their revenues, like you said, are down too, and their deficits are exploding as well. I'm sorry, I get it. So go on. Go ahead.
No, that's okay. But China, meanwhile, is seeing a slowdown because of the trade war, and because they've had a long expansion too, and they're responding to it with higher government spending and easier money, et cetera, the usual response, which means bigger deficits for them too. So government debt is going to soar going forward, no matter what. Whether we have 3 more years of growth or a recession next year, we're going to see massive new deficits and massive increases in government debt.
All over the world.
All over the world, yeah. At a time when we've already hit record levels of debt and blown right through previous record levels. So if the last crisis, which almost ended the global financial system, was debt driven, the next one is going to be much, much more serious, because we've basically doubled the amount of debt that's out there since 2005, 2006. Now, the second prediction is that corporate buybacks, which have been one of the drivers of stock price gains over the past few years, will dry up because, remember, corporations are the ultimate dumb money. They buy their stock back when their stock is going up, and when it hits record levels, that's when you see record corporate buybacks with borrowed money. What the government did this last time around was engineer this process by pushing interest rates for strong corporate borrowers down to close to zero. So corporations could buy their stock back and make positive cash flow on the deal. They borrow at 1%, buy back their stock, which was paying a dividend of 2 or 3%, and then make money. So they did that on a vast scale. And now stocks are starting to roll over. We've seen a bear market for a lot of big stocks in the last few months, which means they'll stop buying back their stock because they'll be terrified. And they have to go to these annual meetings, these shareholders meetings, and explain why they put billions of dollars into their own stock at a record level. And then the stock since then is down by 30 or 40%, which means they basically just threw away a bunch of shareholder money. And that's not conducive to enthusiasm about buying stock going forward. So that knocks one of the legs out of the stock market, out from under the stock market, if that's true. If corporations stop buying, then somebody else is going to have to step in, and it's not clear who does. So that's bad news, other things being equal, for equity prices going forward. The third prediction is that politics are going to get even crazier, which that's going out on the longest limb because politics are already pretty crazy, right? So to say they're going to get crazier is to say they're going to be borderline insane here in the next few years. But we're already seeing it. The new batch of Democratic Congress people just came in, and it's all hitting the fan right now. You got people going on national TV and calling the president obscene names and instituting impeachment procedure against him, and so we're seeing that start already, and Congress has just shown up. So I think that the idea that that things get more extreme from here is not that out of the ordinary and not that hard to believe, and it means that it's going to be hard to get anything done. We're not going to see just gridlock in the U.S. We're going to see chaos. And that means that of the things that should be gotten done, very few of them will be done. And so things are going to be harder going forward and more extreme going forward. And the new presidential election is going to start here shortly. And you've got, 200 Democrat contenders for the presidency this time around, all of them vying for each other, vying with each other to call the president more extreme names on national TV. So yeah, it's going to be extremely contentious going forward in the U.S. and maybe even more so in places like Europe, where what happens when Angela Merkel leaves Germany, which she's going to do pretty soon. She's a lame duck. Who's going to replace her? The far right party is the one that's gaining the most momentum in Germany, and the Green Party, the far left party, is gaining the second most momentum. So, if it's between those two next time around, then that means Europe can descend into chaos. So politics will feed into finance, and finance will feed into politics in the year ahead. And the net result will be a feedback loop that makes things more and more extreme and more uncertain. The problem with all of this from an investing standpoint, though, is you end up with these cross currents that might or might not end up being good for financial assets. For instance, deficits soaring in the U.S. In the short run is pretty good for equities, right? Because you got the government creating huge amounts of new money and sending it out there, and it has to go somewhere. So maybe it goes into stocks. At the same time, you got corporations pulling back from buying back their equities, which is a negative for stock prices. So of those two things, when they're contending out there, which wins? Who knows? No way to tell. So you can't know whether stocks will be strong or weak in the year ahead. And the same thing is true with real assets, where if interest rates go up, because the government is running huge deficits. That's not necessarily good for real assets. But if people start to lose faith in the currencies that we're inflating away ever more aggressively, then that's great for real assets. So from a gold bug standpoint, I would say that's the one thing that's probably certain where most of the cross currents work in precious metals' favor. So I think gold and silver do well in pretty much any kind of a scenario that includes the three things that I'm predicting. Political chaos is good for precious metals. Rising government deficits are good for precious metals, and corporations behaving like dumb money is also good for precious metals. To the extent that corporations don't push up stock prices, that scares people and sends them into real assets. So I think gold and silver are the only highly likely winners in all of this, and everything else is a crapshoot.
What do you think about the big money, like some of the bigger brokerage firms? I don't know if it's Goldman or if it's J.P. Morgan or if it's both, and they're talking about how they're liking gold, and that's kind of unusual for them, for the big players, big name people. Like, well, I like this, I like that, and I like gold. Did I tell you I like gold? I like gold, and I'm like, what are they not saying on CNBC and Fox Business and Bloomberg, and what are they not saying? What are you seeing out there that they're not saying?
Well, you're actually seeing a lot of stuff in the mainstream media about gold. There are a lot of articles coming out saying that it's time to rotate into gold. Even Jim Cramer on CNBC is saying buy gold now. And I think part of that is that the last time around, the mainstream financial community probably, well, they definitely missed the boat on precious metals. They were way late bringing up the fact that precious metals were rising along with stocks in the early 2000s. So this time around, they don't want to make that mistake, and they're going back and thinking, all right, what did well at this stage in the last market? Oh, precious metals. So they're trying hard to rectify the previous overlooking of gold and silver, and that's nice to see. That the mainstream is picking up on precious metals means that some money that is allocated by mainstream, for instance, financial planners, might flow into precious metals that wouldn't have otherwise. And you know what? It doesn't take much. Those are small markets relative to financial assets. If you got just 1% of global investable capital moving into gold and silver, those things would just take off, especially if a lot of it went into silver, because silver is a minuscule market compared to almost any financial asset, certainly treasury bonds or blue chip equities, but also junk bonds and leveraged loans and things like that. If money that now flows into those things flowed into precious metals, then you'd see those things take off in this beautiful arc up to record levels and beyond. And I think there's a good chance that that's what we see coming up, because most mainstream financial assets are in bubble territory now, which means they don't just decline in a gradual way. They've got air pockets under them. And we saw that with the FANG stocks just in the last few months, where Apple, for instance, peaked at 235, 240, and dropped to 150 and change in no time at all. And Google and Facebook and Netflix and Amazon all had declines of similar magnitudes. And that sent a message to the markets out there, and which is that those things aren't risk-free anymore. And if they're not risk-free and they're overvalued by historical valuation measures, then maybe you want to start moving some of your money out of those things and look for something that's undervalued by historical measures. And that's precious metals almost alone. There are very few other things that are cheap relative to their history right now, besides precious metals, because trophy real estate is still insanely expensive. And are you going to buy a Van Gogh right now? No, you're not, probably not, because you're competing with a lot of Chinese and Russian money that will force you to pay way up. But gold and silver are cheap compared to the past few years, and extremely cheap compared to the fundamental valuation measures that you use for them, which is how much fiat currency is out there in the world right now.
Ding, ding, ding.
Excuse me?
They say ding, 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 my friend.
Yeah.
That is the correct, it's and I was hoping you'd get to that. Hold on, it's enormous. I mean, it's it's stupefying. I mean, we went from 165 trillion. I've said this before, roughly, to 250 trillion. This is what Nomi Prince and other people say. Global debt. And then you look at the 21 trillion that's missing at DOD and HUD that the Washington Post wants to say, oh, it all cancels each other out. Add that to the 22 trillion we already have, and you're talking about exploding deficits on top of that. It's a stunning amount. Greg Manarino says, well, whatever that number is, there's an exponent on it. There's a derivative of it, so it's 10x, 20x, 100x. The debt is unseen in human history, at least all the way back to the flood. We don't know much about what happened before the flood, but it's unparalleled in human history. The debt it's stunning if you add it all together. I mean, Egon von Greyert said it's roughly 2 quadrillion, 2,000 trillion. A trillion seconds is what, 30 something years ago. You can't put your. I mean, right? I mean, that's the backdrop that you're talking about gold and silver, which is they're bouncing around mining cost, right? Talk about that.
Well, if you look at the amount, well, actually, let's look at what happens when this finally blows up. The pressure is going to be on currencies, basically, when the financial system starts to spin out of control next time. In other words, people are going to see the amount of debt that we're taking on, see the amount of currency that we're creating to service all this debt, and then wonder what that does to the value of the currencies that are being aggressively created in this way. They'll lose faith in those currencies.
And this is synchronized. This is all going on around the world, not just U.S.
Yeah. And what's unique about this time is, countries have screwed up their currencies since the beginning of time, but they've done it on an individual basis. In other words, the Roman Empire has a hyperinflation, and they go through all the normal steps in the process of hyperinflation, but the rest of the world still has gold and silver, and so the rest of the world, monetarily at least, goes on as before. And France did the same thing. Germany, during the Weimar Republic, did the same thing, where they destroyed their own currencies. Latin America does it all the time. But the rest of the world is not overly affected by these things because nobody else is making the same mistakes at the same time. But this time around, we're all doing it. Every major country in the world has a printing press, which is to say an unlimited credit card. And they're maxing out that credit card. So we're making the mistakes that in the past destroyed one country's currency. But we're all doing it simultaneously.
Wow.
So this time around.
That's great analysis. That's great, crystal clear. Helen Keller, water, default, dollar collapse. What, you know what I'm saying? Anyway, go ahead. But this time around, go back. I love the point. Go ahead.
Okay. So this time around, when people lose faith in several major fiat currencies, they'll in effect be losing faith in the concept of fiat currency. In other words, nobody's going to want the yen if the dollar's blowing up. Nobody's going to want the euro if the yen is blowing up. So we'll see a flight away from the concept of fiat currencies. And then what happens? You get probably Jim Rickards' monetary reset. That's the optimistic scenario. You can get other really horrendously bad things, but let's stick with optimism for a minute and say that some Sunday night, the U.S. and Europe and Japan announced that henceforth their currencies will be names for certain weights of gold. And in the U.S. case, it'll probably be $10,000, give or take, an ounce for gold, which is what it takes to take us back to the level of gold backing of the dollar that prevailed during the classical gold standard. So you have this huge burst of inflation on Monday morning, where you wake up and a gallon of milk is $10 instead of $2, and everything else is up commensurately. But then going forward, your currency is sound again. In other words, it's linked to something that grows about 2% a year and can be exchanged into that thing. Therefore, the money supply grows about 2% a year, and it holds its value. That's something that we've been through. Again, that's nothing crazy in historical terms. We've been through this a lot, and that's the way it works out. And even Weimar Germany, they had this epic hyperinflation that we still talk about to this day. But 6 months after the end, when they went back to a gold-backed currency, they had a sound currency again, and money was stable. That's the way it could work. But it'll be a concerted, coordinated effort around the world to bring this about.
But I just want to come back here, Jim. The concerted effort. I'm going to come back to that concerted effort to bring that out. But you talk about how after 6 months the currency was stable. People lost everything.
The people who trusted the government lost everything. Yeah.
I mean, there were people that didn't recover for generations. They never recovered. I mean, that's what we're talking about here.
Yeah. Well, you basically destroy a generation's savings when you do that. All the people who trusted the government and kept their currency in the national currency, in other words, cash under the mattress or money in the bank, were hit by that inflation. So their savings were diminished by whatever the devaluation of the currency happened to be. And in the Weimar Germany case, the original currency went to zero. So it was a 100% devaluation. Hopefully, it's not that this time around. But you don't know what kind of mistakes these guys will make along the way. So we can't say that for sure. But let's say it's if we go to $10,000 an ounce of gold, that's 6 or 7% or 6 or 7 times devaluation. So let's say 80% drop in the value of the dollar. That would hit the people who trust the government today very hard. In other words, if you have
anybody getting a government check,
yeah, or the cash you put under the mattress, those things diminish in value really dramatically, and that changes the culture. When you wipe out the savings of an entire generation, they no longer trust anybody or anything because they've seen it all taken away from them. So, you look at how our Depression generation acted up through the 1950s. They were extremely conservative because they'd seen it all taken away from them. So you create a generation of people like that. And then the question is, what does that do to politics? Because Germany got Hitler after they had their hyperinflation. And France, after the French Revolution and their hyperinflation, they got Napoleon and a whole generation of European war. So you run the risk of some kind of a dictator coming in. And, we're primed for that already in the U.S. We're just a few steps away from having somebody come in and just tear up the Constitution and just rule by decree. So a hyperinflation here could be the last straw in the destruction of constitutional democracy in the U.S. And, I hate the idea that might be true, but history says that it's a possibility, if not a probability. So it's something that while we're thinking about how much money we'll make in gold if this happens, we also have to be paying attention to what that does to the world at large. In other words, a world of $10,000 gold is great if you own a lot of gold, but it's not great for pretty much any other aspect of your life because it's going to be a very disturbing place if that happens.
And I wanted to talk about, Bob Moriarty at 321 Gold said this back in 2010. This is another of the many possibilities that could happen before we get that hyperinflation and we get a credit seizure. And then all of a sudden, the dollars that you can't get out of the bank become valuable, at least for a short amount of time because of supply and demand. Couldn't we also have a credit seizure?
Well, you could make a case that we've seen something like that over the past decade where there's so much dollar debt out there in the hands of so many people that there's actually a dollar shortage because they need dollars in order to pay the interest on their dollar-denominated debt. And that kind of sounds like a perpetual motion machine when you put it that way. In other words, we issue debt, and that makes the dollar stronger. And
I'm not telling people to go all in on dollars. I'm just saying, Bob Moriarty's point was it'll work really good for a short amount of time. I don't know if that's 3 weeks or 3 months. So, you almost have to hedge yourself with the paper you're saying is going to end up being worthless. It's a damned if you do, damned if you don't type of thing, right? I mean, I'm not telling people to go long the dollar. I'm all for real stuff and real assets, but paper money may come in handy if we get one of these crazy credit seizures. I'm thinking out loud here. Go ahead.
Well, yeah. Some cash is a good thing to have regardless of what you think about the future of the financial system. Just because, as you said, you never know if there's going to be a discontinuity where the other things you used to be able to convert into cash in order to pay your bills are no longer convertible for whatever reason. So yeah, you want some cash on hand. But a seizure in the credit markets is a short-term problem in a world of fiat currencies and unlimited electronic printing presses. Because the way we will respond to a really extreme credit event is by creating a lot of new currency. And we've seen that already. We'll just bail out everybody in sight with newly created dollars. And so we have this, which kind of happened in 2008. We had a stock market crash, which also sent gold just through the floor. Gold fell along with equities. But then the government responded by creating trillions of new dollars, tossing them out into the banking system, and then it was off to the races again. So we could see something like that repeat, but this time around with much bigger numbers. If it took $7 trillion last time, it might take $20 trillion this time. So then the question becomes, is that enough to break the system, to shake people's faith in fiat currencies to the point where we get the Austrian economics crack-up boom? And you can't know that ahead of time because, frankly, I didn't think that 2008, 2009 was possible. I didn't think they could save us because the numbers were so horrendous.
Wow, man, they did crazy stuff. Which brings us to your book, The Money Bubble, which when in the pre-interview, I said, are you going to update that book? He goes, well, no, actually, I was so early that the stuff in the book right now, which is now on your back on your website, you had it off your website, you should put this on. It's a fascinating book. It's you get your money's worth. It's some dark stuff in here when the money bubble pops, right? I mean, that's what you're laying out right now. Relevant, the roadmap of what's happening right now is right here in this book.
Yeah, well, you know what? The story of my life is 3 years too early.
Hey, I listen, as a reporter, I was early on tons of stories, and people thought I had two heads. People thought I was crazy until it happened. I mean, I was telling people all the banks were in trouble and the stock market's going to crash. This was back in 2007 and early 2008, and that the housing was not going to be contained. For that, I got a pink slip. Thank you, CNN. But all that happened, right? But I was early.
Yeah.
And I look crazy. And I know you look crazy when you're early, but you're not crazy. You're crazy like a fox. You're smart. And so that's what I want to talk about. So what's going to happen? What's the ultimate... where does this road end with the money bubble? Because you wrote a book about it. Where does it end?
Yeah, well, when the bubble bursts, we're not talking about a small financial bubble bursting. The previous ones, the ones we've lived through, like tech stocks or housing, they were sector-specific financial bubbles, and they were a big deal. And when they popped, they were a serious problem. But this bubble, they call it the everything bubble now. James Turk and I called it the money bubble in our book. Either way, we're talking government debt around the world, blue chip equities around the world, high-end real estate around the world, and the fiat currencies that all of those things are based on. So this is a whole different animal than subprime mortgages or tech stocks or something like that, because it's global. And it encompasses not hundreds of billions of dollars or a couple of trillion dollars, but tens or hundreds of trillions of dollars out there. So it's not clear, how it goes, obviously, because it's uncharted territory, these kinds of numbers. And it's not clear whether governments can manage something like that and put us back on track for another expansion of 10 years or however many years. I think there's a decent chance that when this one blows up, we can't fix it. There's no way to fix $500 billion of derivatives when they blow up. There's no way to fix total debt of 400% of global GDP when a big chunk of that starts going bad. So then you're in uncharted territory. And what we did in the money bubble, we went back to the currency reset idea, which is to say that all we have left is to wipe the slate clean and say, know what, this thing didn't work. It was a 60 or so year experiment that turned out to have a fatal flaw, which is that you can't hand a printing press to a government. We know that now, and we're going to go back to what worked for the 200 years before that. So So the question is this a chaotic transition or a quick and dirty transition? And that's really it. We don't have a choice of pain free. We just have a choice of what kind of pain we're going to endure in the course of setting up a sound money system that we can go forward with in a sustainable way. And of course, the timing. You can never ask me about timing because I'll always give you the wrong answer, and unless I randomly guess and get it right somehow. To me, it seems like it's imminent. But then it felt imminent in 2006. I thought really that was the end of the global financial system as it was set up. And I feel like that again, but I was wrong last time around. So it's conceivable that they buy us another 10 years with some crazy new monetary experiment. But it's also conceivable that the whole thing comes crashing down around us. So we'll have to see. But I think, you know what? Either way, precious metals get you through this in reasonably good shape.
There's what else is out there. Rob Kirby opined about this. He's at KirbyAnalytics.com. Smart guy, has clients around the world. Does tonnage for people. Very few people. I bet you there are less than 10 people in the world arrange tonnage for clients. And he says, everybody got this wrong. Everybody got this wrong because nobody imagined that they would print crazy amounts of money in the tens of trillions of dollars. That's what this $21 trillion represents of missing. He said, now we know how they did it. They printed more money than anybody PhD level people could wrap their heads around. Now we know how they did it. I don't know if they're going to be able to pull that off again. What I'm saying?
Well, that's the question. Can they do it again? What number breaks the system? And that's what we don't know. We'll look back on this and we'll say, oh yeah, that amount of currency creation did it, or that amount of global debt was where we should have mortgaged the house and used the proceeds to short everything in sight. But we can only know that in retrospect.
Yeah, I don't tell people to do that. I don't know you don't sell anything. So just so people, they're just talking their book. Listen, I don't sell gold. I have a sponsor, Discount Gold and Silver Trading. I never get a call from somebody saying I didn't get my stuff. She ripped me off. She's a crook. She's not, but she makes a commission. You don't sell anything either on your site. You just have information. A good one, dollarcollapse.com, incidentally, which is fabulous. You put a lot of work into that. You really put a lot of work into that. It's a fantastic site, dollarcollapse.com. But go back to about the timing. You were saying that you don't know. What else do you go? Where else do you go? Where else do you, at least part of the way, where else do you go?
Yeah, that's the thing. In a world where all the major asset classes are at bubble levels, where do you go? Because remember, cash is also a bubble right now. In the sense that so much of it has been created and its value hasn't fallen commensurately. It's wildly overvalued. So it is hard to figure out where you hide if you assume that this system is unsustainable and at some point it breaks down. Obviously, precious metals are one of the places that you hide because they're the old kinds of money that we go back to when we screw up our newfangled money. And we've been doing this forever. Every time a country decides they want to use some kind of paper money that isn't 100% backed by precious metals, they screw it up, the money crashes, and they go back to gold and silver. So that's something that history says will work again this time around. And other kinds of real things that governments can't create ought to do well too. I mean, farmland has utility, right? So it's going to hold that utility because people are going to continue to eat even when they can't pay their heating bills, even when they lose their mortgages, they'll still buy food. And so farmland will hold up relatively well. We will still heat whatever structure we're living in. So energy, and we'll still drive to our jobs. So energy will still be in demand, therefore high quality energy assets. Oil stocks, to the extent that oil stays our main source of energy for the next 20 or 30 years, they'll do okay.
As long as brokerages
but that's a
don't go
short
under.
list.
Yeah. Well, the other problem is that buying stock is that, what happens if we have an MF Global event at one of the big brokerage firms? Wait a minute, will you give me my stocks, right? Well, we commingled that. What does that mean? It says you have 100 shares, but really, we own the shares. We just, Well, yeah, we're bankrupt, so you're just a creditor. Well, wait, you said I had the shares. Yeah, I know it said a piece of paper. That's the problem with all the brokerages. They commingle. They commingle your stuff. It's,
Yeah.
I,
Well,
I mean, what we're facing, John, is
that's one of the scary um, scenarios that go along with all of this, which is that when governments get desperate, they start looking around for money, and they'll take it wherever they find it. And for instance, back during the Roman Empire, there was a civil war, and some of the generals were sitting down looking for ways to finance themselves, and they made a list of rich people in Rome who they could accuse of crimes and execute and then confiscate all their wealth. And they did that, and they won. It worked for them. So governments ever since have behaved that way during times of crisis. This time around, where's the money? 401ks and IRAs. That's a multi-trillion-dollar pot of untaxed cash that governments are going to be eyeing when things really start to spin out of control. And so you're right. If you've got a bunch of oil stocks or gold mining stocks in your 401k and you think you're protected, you are protected based on your choice of investments, but maybe you're not protected based on where you've chosen to put those investments, because the government could easily come in and say, you know what, we're going to convert your stocks to treasury bonds.
or your brokerage could go MS
There's
Global.
historical precedent for them having the power to do that. So they could conceivably do it, So you need to diversify.
So
I'm not saying don't have anything in any financial account, but move money into things that are not directly accessible by governments.
So you saying that they could come in? I'm sorry, I interrupt you. Forgive me. Forgive me. You're saying that there's historical precedents. They could come in and say, "Yeah, we need that." With your 401k.
Yeah. Well, in theory, yeah, that's technically possible. And we've imposed wealth taxes on people in the past, and back during the oil crisis of the 1970s, they levied an extra tax on oil, on the oil companies, because they were reaping windfall profits. So we have historical precedent for governments going after people who still have money during hard times, and which just means, store some precious metals in a vault overseas, buy a piece of real estate. It's nice to own a Costa Rican beachfront condo, right? That's got some utility beyond just the financial. But it also puts some of your capital beyond the immediate reach of the IRS. So things like that, or hold gold and silver in hand, not in an account somewhere, which makes it harder for the government to confiscate. You just want to diversify. You can't know who goes crazy, and you can't know what they're going to do when they get really desperate. So what you need to do is spread your capital around to the extent that you can, and assume that some of it will be lost to the coming confiscations, whatever they happen to be, but that a lot of it will survive. That's how diversification works, always and everywhere. And it's especially important at extreme moments in history, which this is definitely one.
If you look at one thing we know for sure, you can see all these other bubbles, whether it's tech or Amazon or luxury apartments. You were talking about stocks. I mean, we're at the end of the longest expansion.
Craig, I can't really hear you right now.
Oh, okay. Hold on. Can you hear me now?
A little better.
Okay. Anyway, the long and short of it is gold and silver are not in a bubble. So that's for sure. Gold and silver are not in a bubble. You can't say, oh, well, bubble territory for gold and silver, right?
Yeah, they've gone down in the last 5 years. They've actually underperformed stocks by a wide margin. And they're one of the only major asset classes that didn't go way up, which that's another thing I was disastrously wrong about starting in 2014, 2015. I figured that if it was possible to reflate the system and bring us back from the brink, that, okay, stocks would go up, but so would gold and silver, right? Because some of that money would flow into precious metals. That is also flowing into tech stocks, for instance. But that didn't happen. All the money flowed into financial assets, and very little of it went into gold and silver, which means you lost money if you bought gold and silver when everything else was going up, which was unfortunate. But you end up with an undervalued asset. No, that's one of the few cheap assets out there, precious metals, which means that you've got some downside protection, other things being equal, because they've gone down, because they're relatively cheap compared to recent history. So if you're approaching things from a value standpoint, in other words, what's gone down and what's relatively cheap, precious metals are almost alone out there among the major asset classes of having gone down and being relatively cheap now.
John Rubino, you can get his book, which I've talked him into putting it back on his website because I think it's a great book. Is The Money Bubble. You can get it on his website, and the website, of course, is dollarcollapse.com. John Rubino, another fabulous interview. Your last one got 120,000 views. You're an affable, likable man, and I really appreciate it. Again, John Rubino, dollarcollapse.com. Thanks for coming on, USAWatchdog.com.
Thanks, Greg.
Oh, wait, hold on. One last thing, and this, I'm going to edit after this. But you can get you have a sign-up page, right? A sign-up page for you. Is that right?
Yeah, I've got a mailing list where I send a lot of posts of my own out via that website, and you can join the mailing list, and then you get them sent to you as soon as they come out.
Okay, cool.
So if you could run a link for that, that would be great.
Yeah, I'll do that. I'll definitely do that.
Can join the list.
And then your book is going to be on the front page of dollarcollapse.com, and then of course your great site dollarcollapse.com, which you put a lot of work into and you update it constantly. So John Rubino, again, that was a false out, but here's a good one. John Rubino, dollarcollapse.com. Thanks for joining us today on USAWatchdog.com.
Thanks, Greg.